Here's something most investors never think about until it's way too late.
And we know you're one of them. So before you buy a single property,
Before you call the seller, before you run the numbers, before you even think about structuring the deal.
you need to know what you're going to do with that property.
Because if you don't know your exit before you buy it,
You're not investing.
I can promise you're going to Las Vegas and gambling.
The market right now has no grace for investors who are figuring it out along the way.
Honestly, we've seen it happen all the time. Good investors, great men, great women, smart people, and then they just get themselves stuck because they really didn't have their exit strategy mapped out.
So in this video, that's what we're going to talk about. We're going to walk you through the 3 of our most profitable exit strategies.
And when to use each one, when it fits your situation, and one most investors, if not all, are actually sleeping on right now.
Stay with us because the last one is going to change how you look at your next deal completely.
So real quick, before we get into it, I do want you guys to recognize something.
Most investors think about exit strategy like it's the last step.
When in reality, it's actually the first step to structuring a fire deal.
And we get it. When you're in the middle of trying to negotiate the deal, the exit feels like a problem for later.
But honestly, that mindset is actually going to cost you, and I can promise you that.
You end up signing deals that work on paper, but they don't produce profits in real life or for another investor.
Because the exit strategy isn't your scapegoat.
It's what determines whether the deal was ever worth it in the first place.
And your exit strategy isn't the end of the deal. It's the whole point. So there's 3 exits we use inside of our business and that we teach inside Roman's Creative Academy.
That's rent to own, long-term rentals, and you becoming the bank.
And look, none of these are new concepts. I'm not going to say that.
But the way most investors are using them or not using them,
that's where all the money is being left on the table.
we're going to walk you through each one, what it actually looks like in practice, when it makes sense, and what kind of risks you're taking when you choose it.
And then what we're going to do is tell you which one we think is the most underutilized exit play in creative financing right now.
You're going to want to hear that part.
Okay, so exit number 1, rent to own, baby, our favorite.
You've heard this before. This is how we burr without the bank.
So in essence, rent to own is you find a tenant buyer, basically someone who wants to own a home but can't qualify for a bank mortgage right now.
So they pay you an option deposit up front, which is applied towards the purchase and when they buy you out down the road.
Then what they're going to do is they're going to pay you monthly rent, right? And you're going to generate cash flow just like a normal rental.
So from day one, you have 2 income streams.
Then at the end of the term, you get a nice fat back-end check when they exercise the option to purchase.
3 profits on 1 deal.
Now, here's what I love about this exit for where we are in the market right now.
There are a lot of people out there who want to own a home, but the rates have pushed them out of the traditional financing.
They're actually qualified buyers, but they do need a little bit of a longer runway.
You can be that runway and get paid well for doing that.
And this is what's awesome, is rent to own is how we help families, and it's one of the most profitable positions you can hold in any market.
So let's talk about exit number 2, long-term rentals.
Which sounds simple, right? You buy it, you hold it, you collect rent.
But in creative finance, hold looks very different than a traditional buy and hold.
Because you come in on seller financing or subject to, which means your interest rates are way lower than normal and your debt pay down is rapid.
And when you acquire on creative terms and hold, you're building in multiple ways simultaneously.
Monthly cash flow between what you owe and what comes in.
Debt pay down on someone else's mortgage or your seller financing note.
And then you have your appreciation over time.
And real estate tax benefits that W-2 investors almost never fully use.
That's 4 different ways that are working for you at the same time, but with creative financing, never having a bank involved.
A hold in creative financing isn't just about the monthly check. It's about building a position that most traditional investors can't even come across.
Now, when does that make sense?
When your cash flow is solid and the area has real upside, you don't need the equity to do your next deal.
And that last part is key.
If you're holding and you're cash flowing, but you're stuck and can't move to your next acquisitions, that's not a hold. That's just being stagnant.
The hold only works when it's part of a bigger picture, per se.
You need to know what the property is doing for your portfolio, not just what it does for you on this month.
Hold is a wealth strategy, right? It's not just a cash flow strategy, and you need to know the difference before you commit.
Now, here's where it gets interesting.
Because exits 1 and 2, rent to own, long-term rentals, those two are the most ones investors know about.
But exit number 3?
This is almost one you'll never hear about people in creative financing talking through.
And in our experience, in this market specifically, it might be the most powerful exit play available to you right now.
And most investors are sleeping on it or are clueless. And that's exit number 3, becoming the bank.
And this is where people's minds usually start to open up in a way that they weren't expecting.
So in easy terms, becoming the bank means you're going to acquire the property on creative finance, and then you're going to turn around and you're going to sell it on seller financing terms to an end buyer.
So instead of cashing out, you become the bank.
You sell on a seller financing note, you set the interest rate, you set the term, you collect that payment every month.
And you make money not just on the spread between what you bought it for and what you sold it for,
but you're collecting buku bucks on that interest every single month over the life of the loan.
We've seen this done where investors made more in interest than they made on the original equity spread.
Because remember, you're not just selling a house. The note is an asset, and the note's paying you every single month, but without ever having to deal with landlord responsibilities.
Here's why this matters so much in today's market.
Most buyers are struggling to get traditional financing.
Which means there's a huge pool of people who want to buy, who can afford to buy, but the bank keeps telling them no.
This is where you come in and you close the gap. You be their lender, and then you get paid like one.
The risk here is lower than a traditional flip because you're not betting on the market moving in your favor before you close.
You're creating the terms, you're controlling the structure, and you're not racing against any timelines.
Most investors are trying to flip their way to financial freedom, one deal at a time. Becoming the bank lets you build a portfolio of notes, income that doesn't require your time to survive.
Okay, so how do you know which one to use?
Here's how we think about it.
Rent to own, when your buyer pool in the area has income but not credit, when your rates are high, and when you want upfront cash and monthly income plus a fat back-end check.
Hold when your cash flow is strong. The area has appreciation potential, and this property fits into a long-term portfolio play, and you need a tax write-off.
3, becoming the bank when you want to create true passive income but without ever managing a tenant.
And here's where most people drop the ball.
These aren't honestly separate decisions.
Sometimes you go in with rent to own and you wind up turning it into a long-term rental.
Sometimes what looks like a rental on the front end may turn into a note if the right buyer comes along.
The best investors don't lock themselves into one exit before they understand the deal. They know all 3 so that they can pivot to the one that makes the most sense when the time comes.
So remember what we said at the beginning of the video. If you don't know your exit before you buy, you're going to Vegas, baby.
That's still true, but here's what we want you to take away from this video.
It's not about picking the perfect exit before you even look at the deal.
It's about understanding all 3 well enough that you can look at a deal and immediately see which one fits.
Because when you can do that, you stop second guessing, you stop overthinking, and you stop letting deals walk because you're not sure what you would do with it.
Clarity on your exit is what turns a nervous investor into a confident one, and confidence is what closes deals.
If you're sitting on deals right now and you're not sure which exit makes sense.
If you're looking at opportunities but you keep talking yourself out of them because you just don't have a clear plan.
That's exactly what we help people do inside Roman's Creative Academy.
We look at your specific market, your specific situation, and help you build a strategy that actually works, not just in theory, but on real deals.
We work with a small number of investors at a single time because this works hands-on.
If you're ready to stop guessing and start executing, apply at the link below. Let's build your exit strategy together.
And in the next video,
We're going to show you how to create a bulletproof buy box.
because knowing your exit, I can promise, is only half the equation.
The other half is making sure that you're buying the right properties. Don't miss it. Disclaimer. This content is provided for educational and informational purposes only. The views and strategies discussed are based on personal experiences and do not guarantee specific results. Real estate investing involves risk, and each individual's financial situation is unique. Always perform your own due diligence and consider professional advice tailored to your circumstances before making investment decisions. This is not a solicitation to attract investors, nor are we marketing any securities. Neither the hosts nor guests assume liability for any outcomes associated with the information provided.